On January 22nd, 2026, something happened that gold analysts have been predicting for years, but few actually believed would arrive this soon. Gold shattered the $5,000 per ounce barrier. Not gradually, not tentatively, explosively. $5,012 per ounce at the peak of the trading session. That's a 42% gain in just 14 months since it crossed $3,500 in November 2024. That's the fastest percentage surge since the 1979-1980 gold rush, when geopolitical chaos and inflation fears sent it from 200 to 850 in less than 2 years. But here's what most people are missing. This isn't just about inflation. This isn't just about central banks buying. This isn't just about geopolitical uncertainty. Those are symptoms. The real story is far more structural, and understanding what's actually driving gold to $5,000 tells you everything you need to know about where it's going next. Because the forces that pushed gold through $5,000 aren't temporary, they're accelerating. And the timeline suggests we're not at the end of this move, we're at the beginning of the acceleration phase. Let me show you exactly what happened, why it happened now, and what the data says about where gold is headed in the next 6 to 12 months. The $5,000 milestone, how we got here. Let's start with the chart, because the price action tells a story most analysts are ignoring. January 2025, gold was trading at $3,950. Consolidating after the December rally, most analysts called for a pullback. Overextended, they said, due for correction. Instead, gold chopped sideways through February and March 2025, building a base between $3,900 and $4,100. Classic accumulation pattern. Big money wasn't selling, they were positioning. Then April arrived. Gold broke $4,200. May pushed through $4,400. June consolidated again. July through September, steady climb. $45,500, $40,600, $4,700. October 2025 brought the first acceleration. Gold surged from $4,650 to $4,850s in 3 weeks. Why? Central bank buying hit records. China added 45 tons in a single month. Russia continued accumulating. India's central bank increased holdings for the 8th consecutive quarter. November and December 2025 saw consolidation between $4,800 and $4,950. The market was coiling. And in mid-January 2026, it exploded. January 13th, gold crossed $4,950. January 17th, $4,980. January 22nd, $5,012. That's a $60 move in 9 days. In percentage terms, that's 1.24%. Doesn't sound like much. But for gold, a $1 trillion market with massive liquidity, that kind of move in that time frame signals something bigger than normal volatility. Here's what the technical picture shows. Gold broke out of a year-long ascending channel. The move to $5,000 brought gold to 123% above its 200-day moving average. Historically, when gold extends more than 120% above its 200-day MA, it either corrects sharply or enters parabolic acceleration. We saw this in 1979 and 2011, and again in 2020. Which path are we on now? That depends on what's driving the demand. And that's where this gets interesting. The Trump factor, policy and perception. Let's talk about the political dimension, because whether you support or oppose the policies, they're moving markets, and gold is no exception. President Trump's second term began January the 20th, 2025. The first year has been marked by aggressive fiscal expansion, trade policy shifts, and geopolitical repositioning, all of which impact gold directly. Fiscal expansion first. The administration pushed through a $2.1 trillion infrastructure and defense package in mid-2025. Deficit spending for fiscal year 2025 hit $2.4 trillion. That's up from $1.8 trillion the prior year. When governments borrow and spend at this scale, it creates monetary pressure. The Federal Reserve has to decide, let interest rates rise naturally, which crashes the economy, or keep them suppressed, which fuels inflation. Either choice weakens the dollar, and weak dollars push investors into gold. Trade policy is the second factor. New tariffs imposed on Chinese imports, along with renegotiated trade terms with Europe and Mexico, have created dollar volatility. When the dollar's role as stable global reserve currency is questioned, even incrementally gold benefits. Here's the mechanism. Countries that export to the US receive dollars. They historically recycled those dollars into US treasuries. But if trade relationships are uncertain, if tariffs make future trade volumes unpredictable, those countries reduce dollar exposure. They buy gold instead. We're seeing this in data. China's treasury holdings dropped from $775 billion in January 2025 to $698 billion by December 2025. That's $77 billion in selling. Where did that money go? Partly into gold. China's official gold reserves increased from 2,264 tons in January 2025 to 2,385 tons by December 2025. That's 121 tons, or approximately 3.9 million ounces. At $4,500 average price, that's $17.5 billion in purchases. The third factor is geopolitical positioning. The administration's approach to Ukraine, Middle East tensions, and relationships with BRICS nations has created uncertainty. Markets don't like uncertainty. Gold loves it. When the U.S. signals reduced military commitment to certain regions, allies question security guarantees. When those guarantees are questioned, those nations diversify reserves. Japan, South Korea, Saudi Arabia all increased gold holdings in 2025. But here's what's most important. The Trump factor isn't just policy, it's perception. Markets are forward-looking. They're not reacting to what's happening now. They're pricing in what might happen in 2026, 2027, 2028. If fiscal deficits continue expanding, if trade relationships remain volatile, if geopolitical uncertainty persists, the dollar loses trust incrementally, and gold becomes the beneficiary. Safe haven flows. The real accelerant. Now let's talk about the demand side, because this is where the surge gets explained. Gold demand in 2025 broke records across multiple categories. Investment demand, central bank demand, and even jewelry demand in emerging markets all surged simultaneously. Investment demand first. Gold ETFs saw net inflows of approximately 285 tons in 2025. That's the highest since 2020, when COVID panic drove 875 tons of inflows. But 2025 wasn't a panic year. It was a strategic accumulation year. Who's buying? Institutional investors, pension funds, sovereign wealth funds. These aren't retail panic buyers. These are sophisticated allocators making long-term decisions. Why now? Because real interest rates remain negative in many jurisdictions. When inflation runs at 3.25% and government bonds yield 4 to 5%, the real return after inflation is marginal. Gold, which yields nothing, suddenly becomes competitive when bonds yield nothing in real terms. Here's the math. A 10-year treasury yields 4.5%. Inflation runs at 3.2%. Real yield is 1.3%. But that 1.3% comes with duration risk, credit risk, and currency risk. Gold has no duration risk, it has minimal credit risk, and it benefits from currency debasement. For institutional allocators, gold at 5 to 310% of a portfolio isn't speculation, it's prudent diversification. Central bank demand is the second factor. And this is the big one. Central banks purchased a record 1,037 tons of gold in 2024. In 2025, preliminary estimates suggest they bought approximately 150 tons. That's 10% higher than the prior record. Who's buying? China, Russia, India, Turkey, Poland, Singapore, UAE. Notice the pattern. These are nations either outside the US alliance structure or hedging their exposure to it. China alone added 121 tons officially. Unofficially, analysts estimate another 200 to 300 tons through non-disclosed channels. Russia continues accumulating despite sanctions. Their official reserves likely exceed 2,500 tons now, though exact figures are state secrets. Why are central banks buying? Because they see what's coming. When a central bank buys gold, it's a strategic decision made years in advance. They're not buying because gold went up. They're buying because they believe the dollar system is becoming less reliable. And here's the key insight. Central bank buying creates a floor under gold prices. When demand comes from entities that never sell, that accumulate regardless of price, it removes supply from the market permanently. This tightens available supply for everyone else, pushing prices higher. The third demand category is jewelry, particularly in Asia. India and China together account for approximately 50% of global gold jewelry demand. In 2025, Indian gold imports hit 950 tons, the second highest on record. Chinese demand recovered post-COVID, adding approximately 650 tons. This matters because jewelry demand in these cultures isn't just ornamental. It's savings. When Indians buy gold jewelry, they're converting currency into a store of value that can be liquidated if needed. It's a form of savings outside the banking system. When Indian rupee weakens or Chinese yuan faces pressure, jewelry demand increases. It's a safe haven flow disguised as consumer demand. The supply side, why $5,000 might be cheap. Now, let's look at supply. Because while demand is surging, supply is stagnant. Global gold mine production in 2025 reached approximately 3,200 tons. That's only marginally higher than 2024's 3,180 tons. Production has been essentially flat since 2018. Why isn't supply increasing? Because gold mining is expensive, difficult, and requires years of lead time. New mine development takes 7 to 10 years from discovery to production. Permitting alone can take 3 or 5 years. Capital costs for a new mine run into billions, and ore grades are declining. The easy gold has been mined. What remains requires deeper drilling, more processing, higher costs. Major producers like Barrick Gold, Newmont, and Anglo Gold Ashanti report declining ore grades across existing operations. To maintain production, they must process more ore to extract the same amount of gold. This increases costs. All-in sustaining costs, AISC, for gold mining, averaged approximately $1,350 per ounce in 2025. That's the full cost, including exploration, development, and sustaining capital. When gold trades at $5,000, miners earn $650 per ounce profit. That's attractive. But it doesn't translate into immediate supply increases because new mines take a decade to build. Recycling is the other supply source. In 2025, approximately 150 tons of gold entered the market through recycling. That's relatively stable. Recycling responds to price with a lag. When gold hits $5,000, people sell old jewelry and scrap. But this supply is limited. Most gold jewelry in India and China isn't sold at any price. It's held generationally. So total supply, mining plus recycling, is approximately 4,350 tons. Total demand, jewelry plus investment plus central banks plus industrial use, exceeded 4,600 tons in 2025. That's a 250-ton deficit. How is the deficit covered? By drawdowns of above-ground stocks, ETF inventories, central bank reserves, private holdings. But these stocks are finite, and once they're drawn down, they don't replenish quickly. This is the supply-demand imbalance driving gold to $5,000. Demand growing, supply flat, deficit covered by inventory drawdowns. Eventually, inventory runs low. Then price has to rise enough to either curtail demand or incentivize new supply. We're in that transition now. What happens next? The 6 to 12 month outlook. So where does gold go from here? Let me show you what the data suggests. Short term, the next 1 to 3 months, gold likely consolidates between 4,850 and 5,150. The move to $5,000 was fast. Markets need to digest. Profit taking will create pullbacks. $4,900 is the first support. If that breaks, 4,750 is next. But pullbacks should be viewed as consolidation, not reversal. Because the structural drivers haven't changed. Fiscal deficits continue. Central banks keep buying. Supply remains constrained. Medium term, 3 to 6 months, gold likely tests $5,300 to $5,500. Why these levels? Because they represent the next Fibonacci extension from the 2020-2025 rally structure. $5,350 is the 161.8% extension. Markets often respect these technical levels. For this to happen, we need continued central bank buying, no major Fed policy shift, and geopolitical tensions to remain elevated. All three are likely. Longer term, 6 to 12 months, the range widens. Here's the logic for $6,000. If central banks continue buying at 1,000 plus tons annually, if U.S. deficits remain above $2 trillion, if trade tensions reduce dollar demand, gold's role as monetary alternative strengthens. When gold becomes the primary reserve diversification asset, price must rise to absorb demand. For context, total above-ground gold stocks are approximately 210,000 tons. If central banks collectively increase their gold reserves from current 17% of total reserves to 25% over 5 years, that requires purchasing approximately 15,000 tons. At current prices, that's $2.4 trillion in buying pressure. Markets would price that in advance, pushing gold substantially higher. The bear case for gold requires several conditions. Fed aggressively hikes rates, inflation drops to 1 to 2%, fiscal deficits shrink dramatically, geopolitical tensions ease, and central banks stop buying. Probability of all 5 happening simultaneously? Low. The base case is continued elevation. Gold holds above $5,000, consolidates, then grinds higher toward $5,500, $6,000 over 12 months. Pullbacks occur, but don't break the uptrend. The historical context, why this matters. Let me put this in perspective. Gold at $5,000 represents a significant milestone, but it's not the end state. In 1980, gold peaked at $850. Adjusted for inflation, that's approximately $3,200 in today's dollars. We're now 56% above the inflation-adjusted 1980 peak. This tells you either we're in a bubble or the structural conditions are worse than 1980. I'd argue it's the latter. In 1980, U.S. federal debt was 30% of GDP. Today, it's 123%. In 1980, the Fed could raise rates to 20% to kill inflation. Today, debt service costs make that impossible. In 1980, the dollar's reserve status was unquestioned. Today, BRICS nations are actively building alternatives. The conditions supporting gold at $5,000 are more structural and less reversible than in 1980, which suggests this isn't a spike, it's a revaluation. Some analysts compare gold's current ratio to money supply. M2 money supply in the US is approximately $21 trillion. Total above ground gold is 210,000 tons, or 6.7 billion ounces. If you divided M2 by gold ounces, you get $134 per ounce. But this ratio assumes all money should be backed by gold. It shouldn't. The relevant metric is what percentage of reserves are held in gold versus dollars. Currently, global reserves are approximately $12 trillion. Of that, gold represents roughly $2.5 trillion at $5,000 per ounce. That's 21%. If that ratio increases to 30%, gold needs to rise to $7,100 per ounce. If it increases to 40%, gold reaches $9,600. These aren't wild projections. They're simple math based on reserve reallocation. Final observations. Gold at $5,000 isn't a bubble, it's a signal. The signal is that trust in fiat currencies is eroding, not collapsing, but eroding. And when trust erodes, wealth flows to assets that can't be printed, debased, or manipulated. The Trump administration's policies accelerated this trend. Fiscal expansion, trade tensions, geopolitical repositioning all create uncertainty. Uncertainty drives safe haven flows. Gold is the ultimate safe haven. Central banks understand this. That's why they're buying at record levels. They're not speculating. They're preparing. The supply-demand imbalance ensures prices remain elevated. You can't print gold. You can't mine it faster than geology allows. You can't create alternatives that carry the same 5,000-year monetary history. For anyone watching this, the question isn't whether gold at $5,000 is expensive. The question is whether the forces that drove it here are temporary or permanent. The data suggests permanent. This doesn't mean gold goes straight up. Corrections happen. $4,950, even $4,500 could be retested. But the trend is up. The structural drivers are intact. And the timeline suggests $5,500, $6,000 by late 2026 is probable, not speculative. Gold's surge to $5,000 is telling you something. The question is whether you're listening. If this analysis gave you a new perspective on what's really driving gold, you might want to follow along. Because over the next 12 months, I'll be tracking every major move, every policy shift, every central bank purchase, and every signal that tells us where gold goes next. The $5,000 milestone isn't the end, it's the beginning of the next phase. And understanding that phase could be the difference between watching from the sidelines and positioning before the next surge. The data is clear, the pattern is established. The question is what you do with this information. History shows that those who understand monetary transitions early protect wealth. Those who don't learn expensive lessons. Gold at $5,000 is a lesson in monetary history. Make sure you're on the right side of it.